Hey everyone, welcome in to another daily editorial here on the KE Report. We're going to be talking rates, the bounce that we are seeing in US interest rates. We're also going to be talking China and some more market rotation with Joel Elconin, co-host of the Benzinga pre-market prep show and editor of the pre-market prep website. Joel, I want to start with the interest rate market in the US. We're seeing bonds sell off, especially today on the back of that stronger jobs data. Maybe the market saying, hey, we won't get as many rate cuts as we're hoping for because you take into account that move today. It's taking back almost a full rate cut. So, well, that's a 25 basis point rate cut. So, Joel, what's your thoughts on the bond market here? Look, rates were heading lower, had been heading lower for about 5 months. Maybe they put in a little bottom here in middle September.
Good afternoon, gentlemen. Thanks for having me here on this first Friday in October. I think that the bond market is trying to tell us something. And in the bond market, if you look at the chart of the TLT or the 30-year bond going into this, they weren't just such a believer that it was a half and a half and that we were just going to, be on this, just major cutting cycle. I think that things could come down on the short end, and I think you'll see that. But I think on the long end, I think that especially with some of the data that you got today, that the economy is still strong and that it's going to take more of, some weakness in the economy to bring down both the short end and the long end. Now, the bond traders are pretty sharp and they are usually out, ahead of things. So the response, today in the bonds versus how the setup was. I mean, the big boys were ahead of the trade, so I know they want to push the Fed, and I know that they want another half in November, a day after the election. I'm just not forecasting that until we see more overall weakness in the economy.
Yeah, Joel, and when Powell talked earlier this week, he kind of made that point that you're making that they're not in a rush to start doing a 50 basis points. They're going to switch to 25s, and they may not do as many cuts next year as the market is pricing in. It seems weird that the market is so excited about these rate cuts, but it would mean the economy is weak. When we look at these jobs data and the last 2 months getting revised higher, when we look at where the GDP is from GDP now and the Fed, it's about 2.5% GDP growth. I just don't see this terrible recession that's looming that everybody's been worried about, Joel. Do you think the markets have gotten overly enthusiastic about all these rate cuts?
Oh, definitely. I mean, and also you also get into the environment, when is good news bad news or bad news or no news is bad news? And today, with the news that you got was good news, right? Good news. The economy is still firing, still, doing well after a period of extended rate. Well, you can watch the Fed funds tool. I mean, overall, my overall opinion has been wrong. I mean, it was blatantly obviously what Powell saying that they were going to go to a half. But I mean, is what you're seeing in the markets today is not a result of those rate cuts that just took place recently. What you're seeing today and in the numbers is just the overall state of the economy. I'd rather see the Fed keep more bullets in the chamber, right? And then when things really get bad, but they're trying to, they got the dual mandate, right? Of, fighting inflation, keeping employment strong. So far, they're walking a fine line, but, they could push those Fed fund tools out, wherever they want. When you're going to be data dependent, the more data that they get, they'll base your decision on. And next week, and the other thing that he said is like, we're not on a preset course. And the way I looked at it was, if a whiff of inflation comes back, because what you got to keep in mind is that the year over year comparisons are going to get a hell of a lot tougher because you had that periods of higher inflation, 5, 6, 7%. Well, those are now falling off the table. So when you're comparing October to last October, it's not going to be as easy year over year comparison.
Yeah, very good point, Joel. And that's why I think a lot of people are saying that inflation will stay relatively elevated. That being said, though, as worried as a lot of people were coming into this month, I know we're only 3.5, let's say, trading days through it. Even with interest rates moving higher today, markets are doing pretty well, and the small caps are doing well too. We can look at tech and the rotation out of tech into all these other sectors. But what do you think about the health of the market now that we're just a few days through trading in this quarter?
I mean, it was off to a rocky start, right? Because of, the geopolitical events. But as it's turned out at this moment, as we speak, it's off to a good start. And it's being led by, NVIDIA. It's being led by your tech. So the fact that, you see that move in utilities, you got to be afraid of heights and a move like this, or at least a period of consolidation. The thing that makes a utility story a little bit more attractive is it kind of has a story now, right? Utilities have always been slow and stodgy and boring, but now this AI craze is now flowing over. You're going to need more electricity. It's flowing in. So now, you have stocks with nice yields, and also you're looking at potential capital appreciation. And also, your nuclear stocks are starting to, get going. So the hunt for more energy is on, and that adds a story to the utility sector and related issues.
Yeah, you're so right. There's such a need for so much more electricity, and I think people are starting to realize all these AI data centers and just expansion and growth are going to require more electricity, more fuel for that electricity. What does that make you think when you look at the pop we've seen in oil? I know there was some geopolitics mixed in this week, but we've seen a move in both nat gas and oil to the upside.
Yeah, I think this move in oil is nothing short of extremely impressive here. Looking at the geopolitical circumstances, I always have my same mantra with oil, and whether it's at 65 or 75, I mean, they're going to be producing as much as they can, putting as much out on the market. So right now, waiting on Israel's reaction to Iran. So you have a boost, but all of a sudden, I mean, I wouldn't want to be long oil if all of a sudden there's peace in the Middle East, where there's certainly very far from that. But, it's given a bid. It's given a bid to those stocks. And once again, I talked about AI and utilities having a story. Well, you have a strong story here for higher crude prices with the geopolitical tensions that are going on.
So, Joel, what else is lifting the rest of the commodity sector? Because especially this week, dollar strong, rates bouncing, but the commodities have also been strong as well.
China. All of a sudden, this Chinese economy is going to turn around on the Golden Week stimulus, and we're going to need more copper to build in China. We're going to need more commodities to fill the expanding economy. So that's playing out in the markets. So it's like increased demand, right? And if the Chinese economy picks up, there's definitely going to be, more of a demand for commodities.
Well, Joel, just to that point, we were talking off mic before this that you think it's possible there are some people in the tech space, in the mega caps, and even just in the general markets, possibly pulling a little off the table to look at rotating into China because there's a big difference in where U.S. stocks are valued and where Chinese stocks are valued. I'd love you to unpack that a little more.
Yeah, I mean, I think with the tech sector, and I mean, they're maybe not necessarily, bearish, the stocks, but what they look at is, where can I get more of a return? I mean, you look at the return that you've had, let's say, in something like NVIDIA. I mean, yeah, it can take out the 140, 150, 160, but along the way, it's going to have to constantly improve earnings, just keep going. Whereas you're looking at some of the Chinese stocks, Alibaba trading at a ridiculous PE, growing earnings. I mean, where's the upside? Is there, more upside in something potentially, that peaked over $300 a few years ago, that just spent forever under $100, long consolidation, 80, 85 area. So I think that that's maybe, keeping some of these high tech, the high flying tech stocks, maybe a little selling pressure, not because the fundamentals are changed, not necessarily that they're bearish, but they're just looking to get more bang for their buck.
So, Joel, what are you watching out for then? Coming through the rest of this month, obviously the election is going to maybe moderate some market moves, but what actually moves these markets moving forward?
Well, of course, the geopolitical situation is, something that we have to take into account. as you said, the election. Let's see what the inflation data is. Really, I'll be looking for that to see, you get a hot number and you could take a quarter point right off the table. So I'll be looking at that. And then also the start of Q3 earnings season. I believe at the end of next week, JP Morgan comes in. So fundamentals, the earnings, the things that matter most, you'll get a little bit of a preview after the jobs number. So that's what I'll be looking at for the remainder of the month. And then, have your head on a swivel during an election because there's going to be a lot of volatility.
Well, Joel, I also know that you're quite a technician and you follow the S&P 500 pretty closely. I'd love you to give us some technical thoughts on it because we continue to hear calls for 6,000, 6,100. Do you think that's a potential based on the longer-term charts? And where are you looking at support and resistance for the S&P 500?
Very well-defined support in the market, and that will be at the lows that you had from earlier in the week. You had three lows, right? This is called the 5730 area, almost an exact double bottom on Wednesday and Thursday. That lines up nicely with the low that you had just above that on September 20th. So I think the bulls are absolutely in control here as long as we can stay above that level. On the upside, I mean, you just have to be cautious here and I look at the old time closing high price of 58.1550. But if you just look at the technical pattern that you ran into in July, right before we had the August tank, and then you came up to the area back again in late September, early October, you're really developing that kind of formation here in the S&Ps. Multiple highs just above 5,800, the all-time high at 5,830. I'll just bring it down to that all-time closing high price. I always like to see things improve, but I think there's a little wall, especially the way we hit that 5803 and a quarter this morning, and there were sellers. There were sellers in the pre-market or early in the session, whether or not they're people that bought the dip early in the week, just looking to ring the short-term cash register, or it's the big boys saying, hey, maybe we're not going to get all the interest rate cuts. Maybe we need to pair off a little bit, especially with the upcoming volatility. So very well-defined area of support and resistance here in the S&P. And as you well know, consolidation can always be the best thing. If we just meander another, a week, I mean, we'll probably meander in this area to the CPI data. So, nothing wrong with some consolidation, especially when it's up near all-time highs.
Absolutely. You're right on that one, Joel. And that's the one thing we need to keep on remembering, just how well the markets have done this year. And, well, I don't know, maybe the strength that could come or natural correction that could also come. Joel Elconin, co-host of the Benzinga Pre-Market Prep Show, also editor of the Pre-Market Prep website, which we will put a link to in the show notes. Joel, great chatting with you again this week. Hope you have a great weekend.
Okay. Thank you, gentlemen.